The next step in the process of journalizing closing entries involves closing all revenue and expense accounts with debit balances. These debit balances need to be transferred to the income summary account to consolidate all income and expense data in one place. To execute this, a journal entry is made. The income summary account is debited to absorb the debit balances, while each revenue and expense account with a debit balance is credited. This ensures that the balances in these temporary accounts are reset to zero, preparing them for the new accounting period. Using the same excerpt of a worksheet that shows the adjusted trial balance and income statement pair of columns, where we can get the accounts and balances that needs to be closed, identify the revenue and expense accounts with debit balances. From the given sample problem, these accounts include sales discounts, purchases, freight in, salaries expense, freight out, depreciation expense, supplies expense, advertising expense, insurance expense, rent expense, interest expense. The closing entry shall be debit income summary and credit sales discounts 2,400, credit purchases 150,000, credit freight in 3,800, credit salaries expense 50,000, credit freight out 4,200, credit depreciation expense 4,200, credit supplies expense 5,600, credit advertising expense 6,000, credit insurance expense 400, credit rent expense 8,000, and credit interest expense 6,666.67. The amount debited to income summary is the total of all the amounts of the accounts credited, which is 241,266.67. This entry, like the previous closing entry for revenue and expense accounts with credit balances, also ensures that the balances of revenue and expense accounts with debit balances are reset to zero, preparing them for the new accounting period.